Hi, this is James Eng of Old Capital, and today we are going to be talking about our cap rates going up or down from here in the multifamily space. And today, really going to be going through sort of a multifamily market update, and then also talk about the current financing market because there's actually been a lot of changes in the last couple of weeks. So I wanted to update you guys on what we're seeing and how to adjust your strategy as you go in and acquire properties or even refinance properties, because that might be a strategy as these values keep moving up. All right, so a little bit about my background. Born and raised in Houston, went to school at UT, and have lived up here in DFW since 2006. I started as a loan underwriter at G Capital, underwriting all types of commercial properties, office, industrial, retail, multifamily. And then in 2015, switched over to Old Capital and have now been originating multifamily loans across the nation with really a focus in on sort of my backyard of Texas, and have done over $1 billion in multifamily loans across over 15,000 units. And at the same time, over the last 6 years, have invested in approximately 30, 35 properties, multifamily properties in DFW, Austin, and San Antonio. So seen multifamily in all different angles, from underwriting to lending to investing. All right, so the question of our cap rates going up or down came up on a investor call. And essentially, the CEO of Camden basically said there's really four drivers of cap rate. Number one, investor demand. Number two, supply and demand of multifamily. Number three, if it's a good inflation hedge. And number four, where are interest rates today, right? Because if interest rates keep going up, then you have to be paid a premium to receive to take on the risk of owning these assets. So let's start with number one on this chart. So investor demand. So where do we see investor demand for 2022 going? So this is on the bottom left, where they feel, where the amount of equity is in the capital markets for just all types of property types, right? So this ULI survey was like, all right, do you think it's going to be oversupplied with equity, undersupplied, or imbalance? And 60% in terms of participants said, okay, there's going to be plenty of equity in the market. And then, okay, so where's that equity going to go? So this was from Newmark and sort of allocations of across office, multifamily, industrial, retail, hospitality. Where's that money going to go? So historically, multifamily has been about a quarter of the allocation, and now it's going to be close to a third of the allocation. So there's this in a sense, this is saying, okay, there's going to be a lot more equity, and where's that equity going to go? It's going to go into multifamily. So this box number one, investor demand, is still going to be there. And this is just for 2022, but a lot of these things don't change that fast. So I think the demand for multifamily is going to continue to be there on the investor side. All right, supply and demand, right? So if there's a ton of supply hitting the market and you do not absorb it, obviously that's going to drive cap rates up because it's going to make things harder to raise rents on, really. So here you can see on multifamily, the absorption across the board. I mean, we see it here, typically it's in that 2 to 300 range in terms of absorption, in terms of number of units. But multifamily this year has been close to 600,000 units in absorption. So RealPage is a little bit more detailed quarter by quarter. But then you can see that, RealPage on this side, had 610,000 units across the board. But then look at this space absorption for retail was pretty much negative, popped up a little bit. Office is still negative, and industrial is the other darling of the world, of the commercial real estate world, and it has still a positive absorption, but this is very positive for multifamily. All right, next thing is a lot of people will invest in real estate because it's an inflation hedge. And so when you look at the price of all these things going up, this is just CPI. And so inflation really, the last, let's say 10 years has stayed around that 2% range, 2 to 3% range on average. And then just, at the beginning of 2021. And then really second, third quarter, it's popped up to 4 or 5%. And so people are feeling it. People are feeling it in the price of everything, whether it's restaurants, whether it's gasoline, whether now in rent. And so people want that inflation hedge with their dollars because they can see that it's not going as far. So they want to invest in things that are sort of annually adjusted for inflation, right? So this is what we're going to start seeing in rents as well. And the last thing is interest rates. So if you think interest rates are going to go up, then it's a lot safer to buy the 10-year treasury. But here's the trend of the 10-year treasury over the last 20 years. And you can see that, there's spikes up and down, but in the overwhelming trend is a downward trend. So, if you don't think, 10-year treasury is really going to move up a ton, then essentially all these things are pointing to, if the investor demand is high, if the absorption is high, if you can keep, having a hedge against inflation and then interest rates stay low, essentially cap rates are going to stay the same or go down. And so while you're underwriting deals, a lot of times you have to put a residual cap rate on there. And a lot of times people will add 50 basis points or 100 basis points, which is conservative. But it looks like based on these four things that cap rates are essentially going to stay the same or go down from here. So this is that spread between your cap rate. So about 475 against a 145 10-year treasury. And so people are going to keep pushing on that until it gets tighter and tighter. And then once you see it down into that, 100 basis point spread, then that's probably when you need to watch out. So if 10-year treasury gets up to 3% and then cap rates are at 4%, then there's a little bit of a pause there because that might signal a little bit of overheating at that point. So let's talk about some interesting other charts that I've seen recently. So this shows unemployment and sort of where percent of job losses that obviously we had a huge negative 15% job loss, came back relatively quick compared to the 08, 09 recession. Like this, I've never seen a chart like this where it's just taken that long, 74 months to get back to the employment that we had. And so, the way that the numbers recently came out in terms of the number of job hirings and the number of jobs that you see posted everywhere that you go, it really is pretty close. We're at 3% across the board. And this is across the entire US. So what we're seeing is some markets, let's say Dallas or Austin, they're already past their peak employment. But some cities like Houston are not there yet. And so, Houston lost a lot of jobs during sort of with the oil pricing going down. Now that's back, but the hiring has not come all the way back. And so we're seeing in some markets that has not come back all the way to peak employment that we saw before, but this is on the right track. And so, it might take another 6 to 12 months before we're all the way back to where we were before all this. All right. And this, I've shown this slide before, but I think it still bears repeating. Just, this chart is simple enough. Basically from September 2019 all the way to February 2021, the rents across the nation were essentially flat, $1,400, let's say on average, across A, B, and C. And now just from February 2021 to September 2021, it's gone up $150. So close to almost 15%, if I do my math right. But that change is essentially, being seen by the largest owners. So the Camden, they have close to, 40, 50,000 units, new lease trade outs of 20%, renewals at 12% across the board. And so we're seeing this across even A, B, and C multifamily product. And this is just going to spur, huge increases in value. It's going to spur a lot of bridge lending, which we're going to talk about in the future part of this presentation. And I think that's a huge thing, that the absorption has driven a lot of occupancy gains, and that's allowed rent growth to continue to be pushed up. And so, for 2.5, almost 2 years, people did not see that rent growth, and we did not see it in T12s, but now we are seeing it. So we're seeing that lease trade out. And then I'm hoping this helps Fannie and Freddie get a little bit more business on their side, because they underwrite to actual rents and they don't underwrite to pro forma rents. So, all right, this is the last piece on the market. And if you think about it, if you choose your market right, if you choose your property type right, and then you put good financing on it, and you have a good property management company, essentially you can't lose with that combination. So the last piece on the market that I want to touch on today was really around where the money is going, and where ULI and PwC sort of survey all of the top investors in the commercial real estate space, and where are they putting their money and why. And so these were the top 10 markets, 2 of them in Texas here, Dallas, Fort Worth, and Austin. Some of the other ones that we're seeing people go into, Nashville was number 1, Phoenix number 3, and then right around Atlanta still there, and then Tampa, St. Petersburg as well. And one of the things that I saw in the report was really, they had a group called magnets, and these magnets were really places where, number 1, jobs were going, number 2, population, and then they were still relatively affordable. And so these cities were all on there. So almost all the Texas markets were there. Dallas, Houston, San Antonio, and Austin were within that magnet city. So I think if you choose a good market, if you choose multifamily, and if you could choose good financing and good management, I think you'll win in this game. So that's sort of the market update for multifamily as of this month. In terms of options, so if you're like, all right, how do I get into multifamily? These are really your 5 main options. In terms of recourse bank loan, you have Freddie Mac SBL, Freddie Mac conventional, Fannie Mae, and non-recourse bridge. So I'm going to touch on each one of these and what really has changed, let's say in the last 30, 45 days. All right, let's start with agency lending. So this came out, and this was a good chart about what the volume that they can. So they're Fannie and Freddie are essentially government agencies, and they can only give out a certain amount. And so this year they decided that 2022 they were going to have an allocation of 78 million for Fannie and 78 million for Freddie. And so this was a increase from 70 million in 2021. So that's a positive sign that this market, this is a huge source of financing for multifamily, is still going to be in the market in 2022 and is going to be very active. So, all right, so let's talk about the 100-pound gorilla. Usually that's Fannie and Freddie, but non-recourse bridge has been the 100-pound gorilla this year in 2021. So the number of bridge players in the market is still very high, right? So when we go out and we shop bridge loans, we are still taking it out to 5, 10, 15 bridge lenders. And we're seeing people, even with agency licenses, doing more bridge loans than agency. And pretty much anybody can be a bridge lender, but it still takes a special license to agency business. But the difference is agency business, they're looking at in-place cash flow. So 125 debt service is what they need, and that's the max that they can give you. And so that has restricted the leverage on a lot of these deals. And so there's still a ton of bridge lenders on the market, but this is reverted down. So typically in the past, bridge loans have been 100, 150 basis points higher than Fannie and Freddie in terms of interest rate. And the competition from bridge lenders has continually gotten higher and higher and higher and more aggressive. And finally, in the fourth quarter of 2021, my analogy is that they have been at the buffet for the whole year, and the last piece of chocolate cake is just not looking as good. And so they have run out of capacity. Their staffs have been essentially worked the whole year. And finally in Q4 in 2021, they're saying, all right, we're finally pushing these rates up. So we used to see pricing in the low 3s on a lot of properties. And now we're seeing that push up to 3.5, 375, and 4% on deals that are, I would say, under 10 million or even under 20 million. So the pricing on these deals has increased. The leverage is about the same. You can get up to 75, even 80% a purchase, 100% of rehab on these deals. So here's an example. If you're in the 20 to $30 million space, experienced borrower, you're still probably in that LIBOR plus 325 range, all in about 335. And then, but if you fall into that $5 to $10 million non-recourse bridge, you're going to probably be in the fours, might be 4.5, all in LIBOR plus 4 to 450. So you're still going to be 4.5, which is 100 basis points wide of Fannie and Freddie. So you have to think about, all right, for this extra leverage, is it worth going down this road and doing a non-recourse bridge? All right, so here's an example that we've used before in terms of, so non-recourse bridge, let's say it's $30 million purchase price. Non-recourse bridge, you can get up to 24 million. Fannie and Freddie, you're all pretty much stuck at 19.5 based off of the in-place cash flow, because they're going to want this 125 debt service, and that is going to restrict the amount that they will loan you. So if you have the equity and you can put down 10.5 million, then go for it. But if you are, raising the money and you only have a set amount of money, you might have to go with the non-recourse bridge. But then obviously remember that your initial term on these loans is typically 3 years, and then you get 2 1-year extensions. All right, these are some of the items that we're going to need if you go after a bridge loan. So just your standard property information, T12 rent roll OM, but then we want to see your CapEx and then your pro forma cash flows. And then they're going to push on what is the track record of the sponsor and how much they are investing in the deal. So most bridge lenders are going to want 5 to 10% of the equity to come from these sponsors. All right, here's a recent deal that we closed over in Fort Worth. 75% of purchase, 3 + 1 + 1, 5 years IO, and then LIBOR plus 325. So this deal, because it was, it's probably over $15 million. The pricing would still be about the same right now. Might be a little bit higher, maybe 335 to 350 over LIBOR. But these types of deals have still been relatively competitive. It's really been the smaller deals that have been more expensive. And so remember, when you go out and get a floating rate loan, is it's priced against LIBOR or SOFR. So here you see, so this was about a year ago, and in 2020 there was no vaccine. Nobody saw an end to insight on when interest rates would rise. But if you flip over, a year later, this is, as of this week, SOFR and LIBOR, they're expected to sort of rise in step with the Fed raising their federal funds rate. And so if they start raising, let's say it's summer 2022, 25 basis points, all of a sudden you're going to be at that 1%, let's say strike, 1% rate by 2023. And so if you're buying a cap now and it's hitting, most of these funds are making you buy caps for 3 years, it's going to start having to pay out at 1%. And so it's going to get a lot more expensive that last year to get that interest rate cap. So here's an example of sort of how much movement there's been. So this is a $20 million loan. In October, we priced it 1% strike. It was $127,000. Okay. In November, we went out and priced it the 1% strike. It's $211,000. So that same coverage is costing, $75,000, $80,000 more in cap premium right now. And where is that cap premium coming from? This is an example, but essentially the first 2 years, there's no way, or very low probability, of that insurance company actually paying out on your money. All of it really comes in year 3 is how much they have to pay out. And so that's what they are charging you for. That's what you're seeing if you have a 1% strike, not until LIBOR SOFR goes above that. And it's just based on forecast right now. No one actually knows, but you are buying that protection. So you're protected for 1% for the first 3 years here. All right. All right, let's jump into, so that's non-recourse bridge. So remember that's a floating rate loan, and you're gonna have to buy that interest rate cap. All right, Fannie Mae. Let's jump into Fannie Mae. So Fannie Mae, what we're seeing is number one, they have floating rate loans above 15 million, and a lot of people are actually going to fixed rate. So if 10-year Treasury sort of stays flat, you can do like a 10-year fixed, 7-year yield maintenance with a step down prepay, and so a lot of people are going with that right now. All right, let's see in terms of pricing. Here's November rates. So essentially you're around 3.5 to 375 on loans right now. And then on your variable rate, your interest rate can be, 2.5 to 265 on the floating rate loan. That's your starting rate. And so they're a little bit cheaper than I would say Freddie Mac on the floating rate side right now because of spreads, but you have to be above $15 million in loan amount. All right, here's the deal that we closed in April. So this was a 10-year loan, 5 years IO, and we did the 7-year yield maintenance penalty. So you got a fixed rate, and then the prepayment penalty, when they go to pay it off, let's say in year 4 or 5, it's actually not that high because it only has 2 years left of yield maintenance. Fannie Mae has no reserves right now on the conventional side, so that's still good news. Let's jump over to Freddie Mac Conventional. So they have a fixed rate product and a floating rate product, and it starts at $7.5 million. So this is for stabilized properties. It's a little bit more difficult for foreign guarantors that they have to put up close to 5% post-close liquidity by themselves, whereas Fannie doesn't require that. And then every deal's got to go to Freddie. So we're working through a couple of Freddie deals right now, and it's a little bit more conservative underwriting. They're going to dig in a little bit more. But for stronger sponsors, this is definitely a great program. We're seeing their pricing. So their pricing in the summer was about 260 over SOFR, and now it's jumped up to about 280, 290 over SOFR right now. So it's a little bit more expensive than Fannie on the floating rate side. This was a loan that we closed over the summer. So it's 287 over SOFR, 3% all in, but it's a 10-year loan term, 5 years IO. So it's a little bit lower leverage. So what you're going to see is Fannie and Freddie are going to be 65 to 70% levered, but then you get a 10-year loan term. Legal costs are lower. You still have to go out and buy the interest rate cap, but you get a little bit more IO, and it's just a little bit safer loan out there. No reserve requirements on Fannie and Freddie right now. All right, Freddie Mac SBL. So this is probably where the biggest change has come in. So they're having a big push on local sponsors. So they want someone close to the action, close to the property, and they really want to see 2 years of experience and that over 3 properties. So they're digging in a little bit more on the experience side. Every deal's got to go to Freddie for approval. So they're easily taking 60 days on most of their deals. And then, so here's a case study of a deal that we financed probably about a year ago, 2020. So they could have went with a bridge loan, maybe a recourse bank loan, but this one was in, it was 95% occupied, just the rents were under market. And so we went with a 7-year loan term, 2 years IO, and 30-year AM. And then it has a step down prepay. So you'd be 4% of the loan amount in year 3 on this deal. So here's some pricing that we've seen recently on, let's say, a $7 million deal. You're anywhere from, let's say, 3.4 to 3.8, depending on what you take and then what type of prepay. So usually you get 1 year IO and 5-year deal, 2 years on 7 and 3 years. And then you can scratch out this COVID reserve. So that's the thing that has changed. Just this last week is that Freddie Mac has removed their COVID reserve. So as of now, they're gone. So if you have a Freddie Mac SBL loan, I would request releasing it if it's currently in escrow with Freddie Mac. All right, this last loan that we're going to talk about is your recourse bank loan. So this is typically $1 to $10 million. Most people don't sign $10 million recourse loans, but in that $1 to $5 million is actually probably where most of them sit. So you're going to sign personally on the deal. And if the bank forecloses and there is any deficit, you're going to be personally responsible for it. Most of these deals are fixed rate for 3 to 5 years, so no interest rate cap. Rates about 375 to 4.5. You're getting about 12 to 24 months of IO, Then it's going to amortizing basis, usually 25 to 30-year AM, just depending on the age of the asset, and then low prepayment. So it could be zero, limited legal fees and closing costs. And these are, so if you're looking to close a loan quickly, these are typically 30 to 45 days. So right now at year end, we're seeing some people go to the recourse bank loans if they do not, if they need to close in 2021 for depreciation or for the seller or for any reason. Fannie, Freddie, and even bridge lenders are backed up pretty much. So if you're sitting here at the beginning of November saying, all right, how am I going to close this loan? This is probably the way that you need to go if you're going to get it done. You're going to need a deposit relationship as well. So typically the operating account of the property needs to go with the bank as well on this. Here's some loans that we've closed just in the last, 3 to 4 months. So we did, non-recourse bridge loans on these two. Century Oaks was a Freddie Mac SBL. This was a recourse bank loan, Ranch at Joyce Lane. Diamond Lock, we talked about earlier, was a Freddie Mac conventional. This was a Fannie Mae. Villa Gardens and Courtyards were Fannie Mae, and then Heritage was a Freddie Mac SBL loan. So we look at all these properties, figure out what the business plan is, and figure out what loan type would be the best based on all that information. So Old Capital, we shop, Fannie, Freddie, Bridge, CMBS, HUD, construction, all of those, sort of figure out what the best loan option is for you. We represent you, the buyer, the whole way through the process. And obviously we help you, get educated, whether it's our podcast or conference, across the board, before the deal, during the deal, and then after the deal. So whether you need help with asset management or loan servicing, we help you with that. And then we charge 1% of the loan amount at close. And so we've been doing this for a long time. I've been doing it since 2015. And so we're actually growing our team here at Old Capital. So if you're looking at getting into the space, if you're in the Texas markets, whether Dallas, Fort Worth, Austin, San Antonio, Houston, we're looking at hiring 1 or 2 people a year. So reach out to me if you have any questions about joining Old Capital. So next steps, definitely subscribe to the channel if you like learning about multifamily market and financing. And then if you need help with a loan term sheet, send me T12 rent roll OM whisper price, and I can get that sized up for you. Or if you just want to, review a deal with me, send me the investment package. We'll go through it. I'll ask you some questions about the deal, and we can chat about it. And then really the first step for anybody to work with me is really completing a personal financial statement. And then we can set up time talking about your current portfolio and then compare that to what you're looking at doing on the acquisition side. And last, if you're interested in joining Old Capital, you can send me an email here, jeng@oldcapitallending.com, with your resume and a little bit about your background and what you're looking to do. And we can jump on the phone and talk some more. Thank you. Thank you for joining this week.